Hello, welcome to Lecture 12, the last lecture in Section 3, one of my personal favorites where we talk about fractals. Now in the next few slides I'm going to show you 4 different charts and I want you to try and guess on what time frame they are on. Here's chart A, chart B, chart C, and chart D. Now try to think, were these each charts over the course of a day, week, month, year, etc.? You probably had a hard time figuring that out. And that's because markets are fractal. So in reality, chart A was weekly bars. Each bar represented 1 week at a time. Chart B was hourly bars. C was daily bars, and D was 5-minute bars. And because markets are organized in a fractal nature, you have a really hard time determining what the scale is unless we have that nice little X and Y axis on our charting platforms. So what exactly are fractals? Well, they were invented by a man named Benoit Mandelbrot while he was studying price action, funny enough. So he got a start in the markets, and fractals are basically infinitely complex, never-ending patterns that are self-similar across different scales. Now, doesn't that sound familiar? What else was self-similar across different time scales at the beginning of the lecture? Price charts. And so these things, these fractals, are created by a simple process that is done over and over again in a recursive loop. So here's an example of what that would look like. Is we have a shape and we continue to zoom in on a portion of the shape and it turns into the place in which we started. So you can keep zooming in and zooming in and zooming in, and you still see the same amount of detail and same amount of characteristics, just like we do in the market. So fractal patterns are something that's very common in nature. They are seen in trees, rivers, coastlines, mountains, etc. And abstract fractals, such as the Mandelbrot set, can be generated by running a simple computer calculation over and over again. And many of you have probably seen the Mandelbrot set. It looks like this. And with this, when we zoom into any part of this particular drawing, we see infinite amount of complexity and recursive loops forming. So as we zoom in, this drawing is not going to get any more simpler. It keeps repeating very exotic, strange, and rough patterns and getting even more detail as we zoom into any area on this picture. So here's a clip of Benoit Mandelbrot on a TED Talk, and he's going to talk about how he first got started in markets and fractal geometry. And so it's going to also be an interesting takeaway as well at the end of this particular part that we're going to go over.
You had asked me at one point or another, how did it all start? What got you in that strange business? What got you to be at the same time a mechanical engineer, a geographer, and a mathematician, and so on, and a physicist? Well, actually, I started, oddly enough, studying stock market prices. And so here I had developed this theory, and I wrote books about it. Financial prices increments. To the left, you see data over a long period. To the right, on top, you see a theory which is very, very fashionable, because it's very easy, and you can write many books very fast about it. So there are thousands of books on that. Now, compare that with the real price increments. And where are real price increments? Well, these other lines include some real price increments and some forgeries which I did. So the idea there was that one must be able to how to say, model price variation. And it went extremely well 50 years ago. For 50 years, people were sort of poo-pooing because they could do it much easier. But I tell you, at this point, people listen to me. These two curves are averages, Standard & Poor, the blue one, and the red one is Standard & Poor, from which the 5 biggest discontinuities are taken out. Now, discontinuities are a nuisance, so in all of many studies of prices, one puts them aside, well, acts of God, and you have the little nonsense which is left. The acts of God on this picture are 5 acts of God are as important as everything else. In other words, it is not acts of God which we can put aside. That is the meat, the problem. If you master these, you master price, and if you don't master this, you can master the little noise as well as you can, but it's not important. Well, here are the curves for it. Now I get to find
So what was interesting about that was not only did studying markets lead him to discovering fractal geometry because of price action, but he also talked about the outlier nature of markets, where if you saw in that graph with the S&P 500, taking out the biggest discontinuities drastically changed the performance of the average. So that fits directly into the Sturgeon's law concept, our pockets of clarity concept, and our outliers concept that we talked about earlier in the course. So here's a quote by him talking about the cotton, and he observed the price variations over a few days for a few decades, and then for a few months over 80 years. So for example, looking at daily bars and then looking at monthly bars, and he saw that all the lines were equally wiggly and had similar statistical characteristics. And that's exactly why at the beginning of the lecture, you can't really tell the difference between the weekly chart and the daily chart and the 5-minute chart. From a practitioner standpoint, we can look at each different time frame and see that there's pivots within pivots and patterns within patterns. So we can start out on the monthly chart, and we see consolidation patterns and trends on the monthly chart. And then as we go in closer, we start to notice that these patterns replicate on all time frames. And this is important to understand because it's going to play into how we execute trades and also how we look into the markets. So we can find patterns on all time frames. The classical patterns that we're going to talk about show up everywhere. And knowing this characteristic of markets can help us further understand how price moves and also enable us to catch even better risk-reward trades. We're going to talk about that a little bit later in the course, but you can see here how I can zoom in on the 4-hour, and we're seeing very similar patterns occur across the market, now down to 1 hour and even the 5-minute mark. Because the markets move fractally and we have patterns on all of the time frames, we need to define trend and consolidation correctly with the time frame that we want to trade. And that's why we talked about the multidimensional forecasting, about determining the time frame, because if you don't, there could be different things going on in price action because of their fractal nature. So we can have a situation like I listed here with the monthly charts uptrending while the weekly chart's consolidating, and then the daily chart's downtrending while the 4 hours consolidating, etc. So the different time frames can show completely different characteristics from a price action perspective, and we need to define what time frame we want to exploit and trade, and so to make sure that we're hitting a trend and not being stuck in some type of consolidation zone. And we can see that here's the 5-minute chart, and it looks like we've had a downtrend with a consolidation and then more muddiness. Now let's back up and see what we see on a 1-hour chart. We see more of a longer term consolidation. And let's back up again to a 4-hour chart. And now the picture's starting to change. So this consolidation could be just a continuation of what looks like to be a bear trend. We have a little bit different context. And now we go out to a daily, and it looks different again. So we see a more clear trend that has occurred, and we also see that we're at the bottom of a longer term consolidation. And if we back out again, that consolidation becomes even more clear on the weekly chart. So depending on what time frame we're on, the daily or the weekly or the 5-minute, etc., can really alter our perspective on whether or not we think a market's trending. So for example, on the 4-hour, we might think that we're in a bear trend here, but on the weekly, we're just in a consolidation zone after a previous bear trend. So these patterns all connect these different time frames, and what happens is smaller time frames break down or complete and merge together to form the pattern seen in the larger time frames, and we call this pattern redefinition. So the smaller patterns end up becoming the building blocks of the larger patterns. And this concept is called nesting and multi-time framing, and we actually can take advantage of the smaller patterns within the bigger patterns from an execution process, and that's an advanced order management technique that we're going to get into later in the course. But for now, I want the key takeaway for you guys to be that the higher time frames always override the lower time frames. So higher time frame patterns have more influence over market trends than any of the lower time frames. And because of that, lower time frame patterns are more noisy, they fail more, and they get influenced more by the larger time frame players. And that's because the market's built in this sort of structure where we have institutions, the biggest guys, the biggest players at the bottom, making up the majority of the large moves, and then hedge funds who are more looking on shorter to mid-term patterns, retail who does sit in the midterm and short term, but can even get to intraday trading. And then finally, HFT and day traders who are on the shortest and tightest time frame and trading multiple times a day. So the amount of money that these guys are, or the amount of money that these guys are putting into the market is relatively less than each level here. And obviously institutions are the biggest boys, the sovereign wealth funds. When they put orders in, they cause huge movements in the market. So they can't be trading on the small time frames. So what ends up happening is those large institutions, because they're operating on a larger time frame, they cause the false breakouts and failed moves on the lower time frames. And we call this chart morphing. So what happens here, this is a chart of the Euro futures, is, for example, we had a daily breakout that occurred right on this bar, but the overall tailwind is in a bear trend here. So the euro started downtrending in 2014, and we've had this huge downtrend in the euro for quite some time. So these shorter term patterns that are popping up and breaking out are breaking out into longer time frame resistance and bias. And that's why we see smaller time frames, those patterns fail a lot more often, is because they're competing against the largest money flows in the market. So because of this nature, our focus is primarily on the largest time frames because they have the least amount of noise and the highest completion rates. There's less people to think about. As a day trader, you have to worry about every type of trader, hedge funds, institutions, etc., fading your moves and influencing your moves. But if you stick at the very top, the high time frames, you're playing with the biggest players. There's not other people you have to worry about coming in and having a significant influence on the market because you're playing with them on their level.